let's start this little live session. I prepped a very special thing for you guys. There's a little cozy fireplace right there. Uh, we're going to talk about a couple companies, and more importantly, I'm going to give you a little bit of an update on what we're doing. Yeah, I think I'm going to start with the update. I'll do a little bit of a rundown, and then we'll go into the nitty gritty part of Enghouse, which is what we're here to talk about. So, context part. So, I'm currently here in my brand new apartment in Bulgaria. I've been looking at a couple companies around Eastern Europe because I think those are very, very interesting and, more importantly, very undervalued. And I found two very interesting companies that I'm going to talk about briefly. One does the repairs for nuclear power plants in Europe, mainly Eastern Europe, but they also do stuff in Germany and France. And they have one of the craziest recurring models I've seen. They do about 50, I'd say 60 million USD, because they do everything in levas and euros. Levas are the currency of Bulgaria. And yeah, they do about 60 million bucks in revenue, and they have a margin of 55%. That's an EBIT margin of 55%. Yeah, crazy company. They're trading at like 100 million bucks. Yeah, so uh, actually, yeah. It should be about 90 million euros, 87 million euros. And the quirk with this company is obviously, Bulgaria. No one is gonna buy anything in Bulgaria, but if we can push them to list in Germany or the UK, which is something I'm already doing, I've been doing it for about a month. That could be a very, very, very interesting company. We're talking about going from 80 million to its fair valuation, which should be around 250, 300 million. That is using like a 10x conservative multiple. I'm not going crazy. Multiple on cash flow, obviously. And the second company I found also has some crazy margins, 25% margin. They do luxury hotels in Greece. Even though they're Bulgarian based, they are mostly, located when it comes to operations on the coast, the Greek coast. Well, we'll talk about those two guys in the near future, particularly on the more paid side of things. But yeah, that is my quick update. As for this thing, before we jump into Enghouse, I wanted to give you sort of a brief overview of the Hermit for you guys, the newer side of things. We do something that, in my opinion, is very simple. And even though most people try to make investing sound super complex, I think we do a fairly good job at simplifying the process, but also highlighting the fact that it takes a very long time to actually do things right. It takes a ton of work to avoid mistakes. And as you know, we run here a fully regulated investment vehicle, and we concentrate on the smaller end of the market, the more overlooked side of the market. We're searching globally, and even though geographically now we stepped over to the eastern part of Europe, I'd say that we are, we have a slight bias for three, maybe four companies. One is 3 or 4 countries. One is currently very difficult to invest in, but I'd say our biases are towards Canada, Japan, obviously Spain, and Argentina. Argentina would be the hardest one to invest in right now. But yeah, we try to do the process globally, and as long as we understand the jurisdictions and the nitty gritty of the industry, we're good to go on that end. And yeah, the way we do it is through the scuttlebutt process. Scuttlebutt just means not treating the stock as a piece of paper, as a stock, more looking at it on a global basis, looking at the operations and the business that's underlying. And we look at it sort of as an ecosystem, just as you would look, I don't know, at the fauna in the Amazon rainforest. We try to look at all the elements that surround the business. So we're talking suppliers, ex-employees, competitors, customers, even regulators. We've actually been dealing with regulators on the Medicaid side of things fairly recently, on the reimbursement codes. We'll talk more about that at the end of the month. But yeah, and at the very end of it, we talk with management, and we sort of close this loop, which takes at the very least 2 or 3 months. In most cases, it usually takes 5 6 months to complete. So slow, pretty expensive as well, because we hire a lot of experts, particularly in those cases where we're not an expert, not necessarily in the industry, but more on like the specific, geographic region and the competitive landscape within, let's say, a province like Calgary or like Alberta could be a great example. And yeah, and that is what leads to our asymmetric view, asymmetric information, aka asymmetric returns. A lot of people just try to simplify it with a valuation model. Those Excel warriors. I've been one of them, so I can't really talk too badly about them. I guess it's a stage of life. But yeah, our goal is to understand more the value chain of things. And I'm going to give you a very good example of something I did recently. And the example is Disneyland in Hong Kong. So Disneyland sells plush toys, those like Mickey Mouse figures that you hug at night, or at least you did when you were younger. The most famous one would obviously be the one with Mickey Mouse, with the figure designed by Walt Disney a long time ago. And so to understand this value chain, you need to understand how those get to you. Those are sold in Disneyland, Hong Kong, and Disneylands around the world. But the point of it is that they're dependent on a few elements. The three critical elements, in my opinion, would be the materials, the design, and then the transportation, getting it there. The materials is fairly easy. You use a bunch of cotton, you use a bunch of filling, and then you do use a bunch of mostly plastic derivatives to sort of concoct this mash that turns into a toy. The design was originally done by Walt Disney, but I'm sure there's been a redesign process to make it more efficient, to make it more cost efficient, to make it more, I don't know, like holiday related, for example, to theme it with multiple things. But those end up with one thing, and that is IP, intellectual property. And the last part would be logistics. So how that's manufactured in this case, Hong Kong. It could be manufactured in Hong Kong and then, driven all the way to the actual park. If you understand those three things, you understand the business and you understand, where it's going, which is the whole point of this. In our case, we want to understand who wins in the industry and why. Obviously, the pricing power that they hold, stuff like contracts, how are those going to be renewed? We want to make and break, sort of touch here and there the balance sheet to understand how, for example, working capital moves. Let's say they have really bad receivables, or they have a lot of inventory that is not being turned over. We want to know that. And then stuff like buybacks, debt repayments, and all that good stuff, where we look at the elements and we try to derive a conclusion of what this thing is going to look like in the near future. And yeah, the way we invest, and I want to stress this a lot, is not by buying up tickers, but by buying up companies. And the company part is very, very, very important. We buy the operations, and more importantly, we buy management. We buy the people that manage it. We buy their incentive systems. We buy their capital allocation behavior. And the outcome of all of this is, you can put it on a spreadsheet, but the point of it is that execution is everything. Fairly recently, an LP sent us over some piece of AI. It's essentially an Excel plugin. It allows you to do valuations super fast. It models the whole thing for you. And my response to him once I used it was this thing is pretty much pointless for us, because the whole point of valuation is it relies on certain assumptions. And this is great if you're valuing Apple or GM or a large consolidated company. But for us, it's pretty much useless, because everything has to do with the assumptions, and the assumptions have to do with this execution and with this information that you get from the scuttlebutt process. So yeah, that's sort of the gist of it. And I wanted to note one very little thing on the Substack, because I don't think I've ever actually talked about this. But the Substack is created for a single purpose, and that is to reduce the fees for LPs. So I knew I wanted to create a fund. I was in the process of creating it, and I transitioned everything to Substack. And the deal with it was that I wanted to get to 0% AUM fees. I don't I don't think those are fair for the LPs. I do believe in performance fees and sharing the revenues, but I don't think that, just for existing, you should be charging people for their money. So instead of that, I tried to monetize the idea by, deriving it, giving it a second life, and sort of publishing the idea, obviously with the consent of all of the LPs. But yeah, and that's essentially why we do it. We do it in three layers. One is to protect the LPs, to give them as much as we can, in this case in the form of fees, but also in the form of information. The second reason we do it is to protect the process. Even though the process is fairly simple, fairly straightforward, it does require a lot of work. And so people, in order to value the work, first of all, can't get it for free. And secondly, and more importantly, uh, it's just like giving out not necessarily a very complex, conclusion to it, but more the tons of hours that we put into it. And I just don't think that part is fair. And thirdly, obviously, the people that are following us, those we want to protect us and take care of as much as possible. And those actually include LPs or LP people that are considering to become LPs. So pretty much it's the same group. Anyway, we're going to go to Enghouse now. Sorry for the not so brief introduction, but I think this is a very good example of how we look for companies, what we look for, all of the cash generators, the durable cash generators, the acquisition specialist type of company, uh, and obviously all the trade-offs that comes with the complexity of building a conglomerate that's almost $1 billion in market cap. So yeah, with all that, uh, we sort of put together a bunch of questions. About 50% of them come from you. The other 50% is ones that I've answered along the way, but I think are very, very important. And so yeah, I think there's 3 or 4 questions that I'm going to give credit to because they're just brilliant questions. I read them and I was like, damn, how did I not think about that? The rest, I'll just ask the question and give you guys the response. Once again, super cozy fireplace. uh, and yeah, I think there's about 20 questions, so I'll try to be brief and to the point. Okay, so first one. If Enghouse is truly a disciplined compounder, why has revenue remained essentially flat for a very long time? And so when we think about compounders, generally we think about companies that are growing at 50% plus type thing. They're exploding because these are companies that are buying the latest software update. They're paying crazy multiples, but because the growth is also crazy, I don't think that's the case for Enghouse at all. They're trying to maximize two things. The one is cash flow, and the other one is acquisition of permanent customer base, I guess. So the cash flow from the already existing business and sort of cross sell to that existing business that they're buying, or the customers from that existing business. And so these guys operate in a space where they're very embedded, they're very hard to replace. They are replaced, but in a very long cycle. So, think of it as more of like a decade replacement. And when they acquire a business, they're not really pushing for upselling. They just want to maximize what they already have by either minimizing the costs or streaming down the costs and maybe cross-selling stuff. So that's they want to stabilize operations. They want to make sure that the customers stay there with them. They can lift margins and then obviously extract cash flows for the foreseeable future. And so, yeah, if you're expecting like a SaaS business with like a 50% growth, I think this is the wrong model to look for. But it is a very good model if you're looking for serial acquirers, which is something I find very interesting. Usually serial acquirers, and this I'm going away from the question, but usually these guys, they do a lot of marketing, but they're not very good at what they do because they try to go too broad. what happens with serial acquirers is they don't usually stick to their niche, to where they're good. So they end up, like diluting, and that creates a bloat when it comes to the team. It creates a bloat when it comes to the actual opportunities. Sometimes a serial acquirer should not purchase companies for like 2 or 3 years because the cycle is wrong, and so the prices are wrong. But people can't do that because they need to justify things based on like quarter-to-quarter basis. So yeah, question number 1. This is all based, by the way, I didn't mention this, but this is all based out of the 2 articles that we already wrote about the company. One is like a full thesis, and the other one is a video going over the latest quarter, the latest update that they released, and we went over some of the figures using Ticker. And on that note, this sounds like promo, but it actually is not. If as I mentioned in the latest post, I got you guys a discount. If you use Hermit20, and I'm sending that on the chat, in your Ticker checkout, if you decide to upgrade, you can just test it for free. But if you use that code, you're going to get a 20% discount forever, and that's valid until the end of December. So if you want to use it, completely up to you. Yeah. Anyway, second question. How do we know that the acquisition strategy actually creates value? So this is a bit harder. What you want to do is you want to understand how the cycle works with these guys. So at the very beginning, when they purchase the company, they're buying the revenues, or at least the revenues from the last 12 months. They're buying up those contracts. So at the very beginning, you get those, boom, you get the revenues. Perhaps you don't get the margins, and that is all because these guys often buy distressed sellers. So these are companies that are not losing heaps of money, but they're at around the break-even mark. So you're gonna instantly get the revenues, but the margins, the actual profit from the business, that's going to take a little bit of time. So these guys are usually, doing divestitures of non-core components of that business. They're stripping costs. They're centralizing the admin, the HR, all that good stuff. And they're reducing stuff like R&D expenses because they don't want to reinvest so much on the operator, on the stuff that they bought. They want to squeeze the cash flow out of it. So they get the asset, they do all this, and within 2 or 3 years, you usually see the improvement in margin. And if you look at the latest post, you actually see the margins increasing over the last, I'd say, 15 years. Yeah, they go from about 10% to currently, I think it's 18. They peaked at like 20%. Talking about EBIT margins, obviously. Yeah. What is the biggest structural difference between Enghouse and your typical private equity roll-up? This is a brilliant question. This was written by Mark. I'm not going to say your surname, but you know who you are. Brilliant question. So private equity optimizes for the exit. Private equity optimizes for the 3 things that they can control, and they want to boost that. Private equity controls the debt. They control the entry/exit price, usually in the form of a multiple. So they control, buying stuff at 5 and selling it at 7. That's usually what they can control through hype and narrative. And they control costs. They can cut costs to usually boost margin. These may be short term. It doesn't imply that they can boost the long term margins for these companies, but definitely in the short term they can boost it. It's one of their levers. With that in mind, that is what private equity does. What Enghouse does is they optimize for permanence. They optimize for having that business, squeezing the cash flow out of it for the next at least 10 years. They're not trying to flip it in 5 years. They're not trying to sell it at any point. What they want is they want to operate it throughout the long-lived, software cycle. Again, 10 years of sorts. Then let's call it 8 to 15 years. And so capital allocation in the case of Enghouse is going to be much slower. The integration is going to be a lot more conservative. You don't want to throw in debt and try to boost this thing for it to grow at 50%. And obviously the technology risk is managed completely different. So what Enghouse does is they manage for obsolescence. What a private equity group would do is they would try to maintain that technological edge. So the private equity group would have a lot more new capex, a lot more R&D. In the case of an Enghouse, they're going to have essentially zero R&D. Brilliant question, by the way. What does the market chronically misprice when it comes to Enghouse's cash flows? I'm paraphrasing here. Okay, so usually investors, when they screen for a company, they're looking for a couple, I'd say, important points, but everyone is looking at the same thing, so perhaps not so important. So there's a lot of push for revenue growth, for example. You want a steady, 20% revenue growth, ideally. But they're not usually screening, because it's very difficult to screen, numerically, quantitatively, for customer captivity. How many years has the customer been with you? And in this case, revenue growth versus the customers being with you are completely they miss the point in the case of Enghouse. What you want is for the customer captivity to be super high. What you want for the customers to be with you for the next 20 years. Because, hey, these are public or, close to public companies or operators. And those usually budget things with stuff like inflation and certain appreciations in mind. And so those long-term contracts are very profitable and very stable. And secondly, and most importantly, they don't really change hands. And understanding that in the case of Enghouse is much, much more important than, having revenue growth or looking at ARR figures. ARR is fantastic, but not all ARRs are created equally, if you know what I mean. The ARR of a company like a Netflix of sorts, where you have a subscription model and you need to renew every month, is not the same as the ARR from a multi-year contract with the police of, I don't know, Seattle. It's going to be a completely different thing. Both count as ARR, but they're not the same thing, obviously. I think that answers the question. Yeah. We can go into switching costs there, and like regulatory approval in the case of Enghouse, or like procurement, but I think there's more questions about that. How much of Enghouse's reported earnings are distorted, and how does this affect valuation? So there's a massive distortion with Enghouse, and that is the fact that they don't really invest. So you're gonna have amortization or depreciation in the case of intangibles. Those are not really. There's no, like, they're not spending enough capex to get to break even. So no maintenance capex really. There's a bit of new capex. So these are assets that the company is literally waiting to, for it to get to zero in value. And as you know, the price of a building can be amortized in 10 years. The price of certain software can be amortized in like a year, 2, 3. Think about a video game, for example. Video games get about 50% of their value reduced in a single year. So no, it depends on the software. What they're trying to do is get software that lasts the entire cycle. But obviously, if you're amortizing but not investing, that's going to change the accounting part of things, but not so much the cash making. So you may get a distorted view of the EBIT margin, which goes, after depreciation and amortization. EBITDA could be a better indicator of where these guys are at some points. If you look at the entire series, it doesn't really matter. If you look at a photograph of like a certain quarter, it doesn't matter. What would happen to Enghouse if a real recession hit instead of a slowdown? Okay, so recession versus slowdown. Obviously, if things go south, everyone is gonna suffer a little bit, and in this case, new licenses are gonna go down. Stuff like some project work is gonna pause, obviously. That means the organic growth is going to reduce, perhaps not so dramatically because these guys are not growing organically that much. But you do need to take into account that particularly the asset segment, the asset AAIM, if I'm not mistaken, is the name of the second segment that the company manages. It's essentially maintenance and support, and it's embedded within the contracts that they signed that this is going to persist for the next 4 or 5 years. So a single recession will not change this, and it won't change the cash flow. These guys are operating I don't know, like the lighting within a city, or the like emergency operators comms. That's not going to change regardless of whether there's a recession or not. Sure, there's going to be budget increases and decreases, but this is very, very, very critical software. So, unchanged in the case of a recession, particularly on the maintenance, the AIM side of things. Where exactly does the long-term technological obsolescence risk hit the company? Okay, this is a complex question, but again, these guys are not really updating the software. They are, updating it, but they're not like, you're not going to get bombarded by like AI talk with these guys. That won't make any. Again, it would alter the business model completely. This means they're not really in danger for like a year or two. In 10 years, there could be massive erosion of what their business model does, because some of the software will become obsolete, obviously. But there's like so many additional points that make it super hard for particularly the public segment to switch. So just on the regulatory and compliance side alone, a procurement process is going to take any competitor like 2 or 3 years to switch the software. And even with the 2 or 3 year time period, you're gonna have like another year or two for the market to shift and for their service to fade out and the next guys come in. So there's so much time to prepare. There's so many deals that you can do to essentially buy out the competitor, that it feels very, very, very difficult for these guys to essentially become obsolescent within a time frame that they cannot manage. It sounds like I'm advocating for the company here, by the way. I don't think I am at all. I'm trying to be very realistic about what they do. This is a company that has been on a downward spiral when it comes to price, but has kept on increasing when it comes to revenue and margin. So I just don't understand the imbalance of both. You're seeing the price goes down and this business just going up. Sure, it's not the most exciting business, but it's a really, really good business, and they're actually good at what they do, which in this case is acquiring other companies. So that done. How do we distinguish between a disciplined acquirer and a desperate one? Very easy, very good question. This comes from Carl. Okay, thank you, Carl. You know who you are. The answer for this is dry powder. It's the amount of cash that you actually have. A lot of these deals are financed with debt. In the case of Enghouse, they have like 1/4, more than one that, in cash, just sitting there. They're not in a rush to buy in frothy markets. They're just waiting for a very good opportunity, in their case between 5 and 50 million in revenue, and they're going to pay 0.7 to 1 times that. So, about 3 million to 50 million, that's their ticket. That's what they're looking for. If they find it, they'll just, go for it. But the fact that they have a lot of dry powder tells you a lot about being a disciplined acquirer, which is usually not the case, because what we see out there is the private equity guys, they need to, they just raise the fund, they need to deploy their money within like 2 or 3 years, and then they need to exit in like year 7 or whatever. That is usually not a sign of being a disciplined acquirer. These guys have time on their side. Very good question, Carl. Next question: could Enghouse be underinvested in innovation? 100%. I think this is actually the biggest risk. They're really underinvested in innovation, but that's the whole point of the model. Like, they're buying the innovation, they're not investing in it directly. So we will see churn based on innovation, but at the same time, there's going to be additional companies that they're buying that will sort of supply that innovation side, if you know what I mean. Yeah, I think it's embedded in the model. Why is customer concentration the wrong primary risk to monitor? Well, I don't think it's the wrong primary risk per se. I'd say that this is a question I asked myself, because in this case, the company, management told me about how they deal with this. But in this case, I think that the company is much more vulnerable to regulatory changes. So if there's a change in regulation in, let's say, a state uh, in the US, but these guys can lose 10, 15 clients in one go. They can lose like 10 or 20 million from the revenue in a single quarter, just because the new standard, the new regulatory standard for the service that they provide, does not meet the current softwares. You know, the specs don't match, and that would lead to perhaps not cancellation of the contracts, but definitely there's going to be like a warning period. And these guys, they're not investing in new stuff, so they're not investing in new capex. I mean, so so that would make their contracts, essentially within a time frame of 6 to 12 months, they would essentially become obsolete through regulation. And so there will be a change in the provider. And that, I'd say, is actually the biggest risk. Changes in regulations, particularly on the public end of things, telecom operators as well. Anything that has to do with infrastructure, massive, massive, massive risk there. So we should be looking at that. Oh, reimbursements as well. Anything that has to do with reimbursements changing, or like procurements changing, massive risk for these guys. How does the company generate pricing power? Generate pricing power? I don't think they generate pricing power per se. They can increase prices, but the prices are usually stipulated on a contract by contract basis, and they're linked to stuff like inflation or new budgets, percentage of the budget of the department of, I don't know, like the police of the New York police, something like that. That would change the pricing, but they're not really the people doing the pricing. What the stuff that they offer is fairly commoditized. It's fairly like out there. It's not anything new per se, but at the same time, it's being deployed by the same people, so they're very familiar with it. So the stickiness really doesn't come from price; it comes from the maintenance, the support, the being habitual. That's where this thing lies. So yeah, I guess changing suppliers could change prices, but uh, bolt-on acquisitions as well. If you buy software that complements what you're already doing, instead of selling a bundle that costs $20, you can add $1 per month on top of the already existing contract. So a little bit of cross-selling, I guess. There's where their pricing power lies, but again, not the most powerful when it comes to pricing their software. What is the most analytical mistake that people do when modeling Enghouse? So the modeling mistake I think people do, particularly the analysts that cover the company, so investment bankers, probably the capital allocation, the stuff I just mentioned. So the best sign of a good serial acquirer is the cash that they have in hand. The cost of capital for these guys, they have like $10 million in debt and $280 million in cash. Okay, so massive imbalance. But the cost of this is like 4.5%. If they wanted to buy anything with a cost of debt of 4.5%, their ability to get a project and land in and it still be profitable in like a numerical sense is massive. And people don't understand that, because usually when you're taking out debt and it's costing you 11%, the very minimum that you want as a return for your project is like 15%. These guys can potentially, it's not like they do it because they have like a 5 to 7 year payback period time reference. That's 14%. So 1 by 7 is 14.14% to 1 divided by 5, which is 20%. That is sort of the return that they want on their capital. But beyond that, because their cost is so low, the margin that they get on that deployed capital is ridiculously high. And that is not really something you can model. It's very difficult to model. The only way you can technically model is by reducing the overall WACC for the company. But at the same time, if you want to be conservative, I'd still use like a 10% WACC for the company, even though you can potentially like use a 7% WACC for, weighted average cost of capital for the company. Why does it appear cheap without? Yeah, why does Enghouse look cheap quantitatively? I'm paraphrasing again here. So in general, serial acquirers are a fad, are in vogue around certain times. We're seeing, for example, Constellation Software, which is probably the most famous serial acquirer out there, listed serial acquirer, going down in price. And so there's a bit of a trendiness, whether these things are trendy or not. There's also, people look at TAM as like their absolute, and in this case, TAM and storytelling, technically. TAM is not really the goal for these guys. These guys are sticking to what they know. They're not looking for industries like ChatGPT of sorts, where you want like hundreds and hundreds of millions of users. No, you just want the fire department of, random city in the Midwest to keep on using your software. And even though they have, they went from 10,000 inhabitants to 11,000 inhabitants, massive growth, 10% growth in population, they're not going to hire any more people. They're not going to get more expensive software. It's going to just roll with inflation. So fairly steady. And that's not exciting for people or for investors out there. Sensitivity to interest rates. So the question is, how, I'm paraphrasing here, guys. How do interest rates affect these type of companies, I guess? So on the acquisition side, interest rates are a very, very important thing, because usually defines your borrowing rate. In this case, because they're not borrowing any money, it just changes their valuation overall. So as interest rates drop, we should see higher valuation, but just as we'd see with any other companies. In this case, it doesn't affect their acquisition decision, and it doesn't really affect their cost of debt, because they don't really have any debt. So fairly special case. We shouldn't see a massive increase in value when interest rates drop, nor should we see a massive decrease in value when interest rates increase, because they don't have that much of a bearing, other than obviously like cost of equity / opportunity cost. What specific behavior do you like about the capital allocation discipline? I think I already talked about this. There's no really any need for financing, and that allows them to buy at one side of the cycle, which is usually where everyone wants to sell, where the multiples are depressed because they just have the cash in hand. It's true that you need to be careful with like some of the accounting with these guys for the capital allocation. So again, depreciation would be one. Goodwill and impairments in general would be number two, because they're not reinvesting in the company, and you should track that very, very, very closely. Goodwill in this case is going to be a software and be the client, and like client retention, which we talked about when it comes to procurement / regulatory risk. I think we answered this already. How would you think about downside risk with Enghouse? I think we talked about the recession and smaller recessions. Yeah. Well, overall, just I'll go again over this, but erosion is what the main risk for the company, and what we want is to see, I guess, renewal rates. We want to see see clients, enlisting again for the 20th year. And yeah, in general, in acquisitions, maybe cross-selling, that would be stuff that we want to see because that avoids downside risk. It just makes the product even more sticky. What would a full cycle holding of Enghouse look like? Ooh, that's a very good question, actually. This is Alex from, well, I can't say the country. Anyway, Alex, you know who you are. I'm paraphrasing your question here, but I'd say it would take a decade or more of you looking at the company to actually understand and, you know, how it affects you in a full cycle. There's going to be sporadic re-ratings. There's going to be multiple expansions and collapses from time to time. But these guys in 2009, 2008, right before the crisis, they had about 50 million bucks in revenue. Right now, they have 500 million. If you look at it with that time frame in mind, massive growth, and we should see an equal growth in the stock. If it re-rates, it can go from the current 10 times PE, 15 times PE to 30 times PE. In the at the top of the cycle, you can see 40 times PE or something like that. But again, that is just a product of whatever the latest fad is. As per revenue, I think it's pretty much a straight line upwards. You're gonna have periods where you have an extraordinary purchase and you increase revenues by 20% or 40% in a year, something crazy like that. You're also gonna have periods where the company has to impair certain intangibles, and you're just gonna lose money, even though revenues might look the same in terms of accounting. You're gonna not make as much money. I don't think there's a single period, and by period I mean full year, where these guys have lost money. I don't think that has ever happened, and I'm talking since 1984, so a very long time. In what scenario does Enghouse actually deserve to trade at this multiple? Okay, so if we actually see stagnant growth where they're buying companies, but at the same time they're losing the same revenues organically, that would deserve a much lower valuation, like the current valuation, or even lower, actually. If there's essentially a flat line in revenue, even though they're still going to generate cash, if revenue is accounted at zero for infinity, then multiples would be justified, right? We do want a little bit of growth, even though this growth, again, is going to be inorganic. We'll have plus 10% inorganic and minus 2% organic. Something like that would be something we expect and that we push for. Ooh, amazing. Thank you very much, Maria. I think you're the only non-male part on the audience. But this is a fantastic question. Why is Enghouse a good stress test for an investor's process? Fantastic question. This is the anti-hype stock. There's no excitement. There's no speed. There's essentially zero storytelling. There's no narratives in the news that push for this thing to go up. This is relying strictly on discipline, on having a good process when it comes to acquiring companies and having a process when it comes to integrating those companies. If those two things are correct, the price of the stock will go up. But it's not gonna, be headline in any sort of news, not even local news. So it's gonna bore some people to death. It's gonna mislead a lot of people because they're gonna project things at zero revenue. But in the end, if they can maintain the two processes, so the acquiring process and the integration process, they're good to go. It sounds like a simple thing. It really isn't. Execution is everything here. Okay, what parts become more visible, I guess would be the word, through scuttlebutt? So how does scuttlebutt improve, the information in the Enghouse story? I think the biggest thing it did for us was the customer dependence / customer concentration side of things. So instead of thinking about customers as a unit where you add or subtract a customer. The scuttlebutt process, particularly the experts, but also some of the employees, they helped us understand that it's more about the regulatory risk. Because if you lose a customer, it doesn't really signal anything. If you lose 12 customers, it signals that regulatorily, there's a part of compliance that you're missing, and that is the actual risk. Customers are, or individual customer dependence is not a bad thing. What is bad would be your inability to react to certain legal changes, certain regulatory changes. Oh, this is an easy. This is also a decent question, not an excellent question, but it's talking about measuring companies and their performance. Why does cash flow yield matter more than anything else? So cash flow is our Northern Star. Cash flow yield, and to be precise, a 15% cash flow yield is sort of our standard. It's not really that it's super important. It's like a minimum. So if it doesn't get to 15%, it's not something we're going to buy. And that's pretty much it. And in this case, because these guys, Enghouse, are doing deals where the rate of return matches our rate of return, that's fantastic. Again, they're looking for a payback of 5 to 7 years. That's between a 14% and a 20% return, free cash flow, as in cash return on their investment. And that matches our minimum of 15%, or almost entirely matches it. So we're very happy because, it's like having an aligned vision. And in this case, it's very applicable. What determines whether Enghouse compounds at 15%, at 5% or 15% over the next decade? So I wouldn't say it's revenue. I wouldn't say it's multiple expansion. I think it's their ability to acquire and integrate again. I'm sounding like a broken record here, but the difference between it being a good investment and an excellent investment, and just to sort of frame it using the rule of 72, a 7% return compounded for the next decade would be a 2x. If we had a 15%, that would mean it doubled 4 times. So it would be an 8x. Well, 2x versus 8x. 8x, obviously. The difference is the integration and their ability to keep on purchasing the exact same type of businesses. I'd say, that's the name of the game. I think if you look at their stats, they're very representative of how this thing is going up in a straight line. The only concern I would have is whether changes in management, and management is fairly old at this point, would alter the philosophy and obviously the execution of this. But yeah, I think that is it. I don't know if you guys asked any questions through the chat. This is the time for you to go ahead and ask me a bunch of questions. I think on my end, I am covered. I skipped a couple questions, but they're mostly stuff that I partially answered or fully answered with multiple other responses. Let me know what you think about the cozy fireplace. I personally really like it, and it's the way I love some background music and some background fire, burning type thing when I work. Anyway, that's gonna be it. I'm going to post this recording, and hopefully, I'll see you around, guys. Ciao, ciao.